Weekend greetings, fellow traders. This is Austin. It's Saturday, April 19th. It is the day before Easter, so happy holidays. To those of you who do celebrate this holiday, taking a quick look at a couple of markets, some ideas for next week. Now, first of all, I preface all of these videos and conversations with nobody on earth knows for sure what anything is going to do going forward. We have no idea, you, me, nor anyone else on earth, with the exception of some perhaps government insiders who may move the markets. But let me say this, most traders have no idea for sure what the market's going to do. We can only look at the charts and try to form a few game plans. In other words, if it does this, then we'll do that. So taking a peek at the daily chart, the S&P first, and I've marked these two zones down here. I'll talk about them in a little bit. We see heightened volatility, but it's pretty much sideways, while the Russell, the small caps and the Nasdaq have come apart at the seams, and they've shed a lot of ground. The S&P is pretty much just chopped through this megaphone pattern since the 1st of March. We had this little bit of volatility late in January, and then they went right back up. Here was the V, and then it got really quiet again, really quiet, and then they kind of wedged up here a little bit, and they did the same V turn again. V up, V down. So volatility is sideways in the S&P. That said, we can't do much with that. So take a peek at what there is. Start with trend lines. Let me see here. I didn't want that. I wanted F3. I want array. So here's array, and I'm just connecting waypoints. So let's connect this, and then let's connect this. And these are two potential waypoints that the market may respect. All right, so if they sell off again, which a lot of people think is likely, including me, if they sell off again, then here's a zone of support around 1718, 1719. It's going to be a key inflection point and a magnet down for now. Let's do a Fibonacci retracement grid. I don't really trade off these, but I look at them for support and resistance zones. 78% is a key level to the market. It always has been, it always will be. It's seldom talked about, but that's generally the line in the sand. If price is going to hold, or it's going to confirm a true break going the other direction, it generally happens around there. So that's that. But what I'm looking at here is, see the confluence around the 1788, let's call it 1790, 1780 to 1790 zone, this 10-point range here. There is trend line confluence with 68% of this large swing from the lows in February to the current peak in April. All right, so price comes down now from 1858 to 1780. There's about 70 points of error there, a little more than that actually, 70 plus points of error potential. Now long term, and we're talking it could take weeks or months, these two values project to be hit down here at some point, and they project based on what's going on up here. Right? If you take some strategic measurements from what's going on up here, you'll arrive at these values down here, which correlate with, let's see what they match up with. Well, this prior resistance, it should be expected to be support, and then somewhere in this congestion here was support. They gapped them down. This is a day chart. This is where they did the gap down, gap up thing. There's a lot of Swiss cheese here. So long term, we're talking out there a ways, not anytime soon unless things collapse. These levels project, and we'll leave them on the chart. Oh, let's look at the Russell. What else I'm trading? Trading the S&P and trading the Russell. We're doing that in group fashion starting Monday. Remember we said about 78%? That's what the Russell based off. It came down and it sat on 78% of this low to high swing twice. It hit it one session, hit it, I guess that would be last Friday, 2 Fridays ago. No, last Friday. And then um, last Monday, prior Friday, last Monday, Tuesday, Wednesday, Thursday. You can see where that Friday and then there was a weekend and then Monday they both tested there, and then Tuesday was when they did the selling and the hammer straight back up. All right, so this zone is going to be key here. That's something to watch around 1100 to 1103 area. Let's call it the 1103 in the Russell. That's going to be it's going to be a key area, and you can see where there's a lot of prior congestion. If you look back on daily closes, it was resistance for a while in October of 13, and then they chopped around it, so still remains in play. So there's that. For the same reasons that the S&P projects down to in the 1700s and so on, the Russell projects down to around 1030, and then the 980 zones long term, based on what's going on up here. All right, so that's just the way it measures out technically, and you can see where those were magnetic zones in the past, and so zones in the past tend to come back into play in the future. They tend to get retested. So that's what I see in the charts, and what I'm going to do with this information, I'm going to trade the long side if I get long confirms. If price action is in the bullish zones, I'm going to be a buyer all the way. No questions asked. But if price enters the sell zones, then I'm going to be holding for some greater distances. So let me say that a different way. I'm going to look for bigger profit potential on the sell side than I'm going to look for profit potential on the long side, because the market is fundamentally in a position of weakness at the very least. Now it's deceiving to look at the S&P, to see where it is. And here's the Nasdaq. I mean, it came apart at the seams. Look at these huge range days, large volume, erasing all of this stuff. This is nothingness here. This is nothing, and it's Swiss cheese, and it's holes, and it's gaps, and absolutely no range. And then this is the market really coming apart. It did base down here. You can see these three hammers. The market's defended the 3400 level 3 times. It was resistance back in November of 13. And then it was support in December, it was support in early February, and it has been support last week. If the 3400 zone gives way, then she's heading much lower. I didn't measure this one out, but it's going to be probably down in this area here, down around the 3100, 3150 area. So if they lose the 3400 level, close below that on a daily basis, then look for it to shed 200-300 points in the not too distant future. That's the way I see it. And what I'm going to do with this information, I don't look at the charts just to say, well, I'll keep an eye on those spots. Those are downside magnets of attraction, and that's the shape that the market is in right now. And it could bounce, and it could lift, and it could pop, and it could chop, and it could struggle to rise, or it could go straight up. It could do a number of things. We're 8 sessions away from the end of the month, so there's that. However, sell in May and go away is in the back of everyone's minds who's an investor. They see this type of thing. They see the big leadership stocks have really shed value, and there's nervousness, right? And everyone knows that May is a tough month for stocks, and the beginning of a tough stretch for stocks at times. Number two, the leadership has really taken a beating, and it might be a while until the leadership shapes up and can overcome this. And lastly, the downside is likely to get tested again. I doubt that there's any kind of lasting bottoms here, based on what we see. It's most likely there's going to be a retest. And so from an intraday trader's perspective, if they're selling off into a downtrend, now is where you look to hold for bigger gains. And in our case, our potential profits are self-adjusting to the setups themselves. So to say that another way, Monday comes, Tuesday, Wednesday, Thursday, Friday, we're trading group fashion, S&P, Russell. We get sell signals. they might very well measure to project larger profit potential. And some of those patterns, if you're part of that program, you may be sitting in the room and we're looking at it together and we measure it out together. We all see the same thing. I'm like, okay, this trade in the Russell projects 12 points or 14 points is where it's pointing towards. Same thing with the S&P. This trade is suggesting a 16 or an 18 point target. That may seem implausible, especially because we've witnessed so much chop in the recent year or two, and we've seen everything we have. However, it's important to trust the price action predictions themselves. When price action projects a level, it will hit it more often than not. It doesn't mean every time, but it means more often than not. So, moral of the story: I'm trading without bias. No, my objective is whichever way price is confirming is whichever way I'm trading. But I'm still leaning to the downside. It looks to me like the market has more downside work to do. And if we get sell signals and they're projecting some rather large profit potential, I'm going to get in some shorts. I'm going to add size to them, and I'm going to hang in there tooth and nail looking for those bigger gains to be captured, because that's how you make real money in trading. No matter what it is, you make real money in trading with a decent number of triples and home runs. Nobody ever made substantial money in trading by hitting singles and little bunts and things like that. You really have to catch some big trades at times to pad the stats. We may have that potential ahead of us, and it might be straight ahead. Hope this helps. Look forward to trading with you personally next week. And as always, best trading wishes.